Netflix earnings just came out. Revenue grew 13%, margin hits 33%, among the best in the media, and yet the stock crashed hard. So, what did Wall Street see that the headline numbers missed? Because this was not about one quarter, it was about the three bigger questions. Is Netflix still growing through more engagement? Is that growth converting into sustainable cash? And is the stock still worth the premium? Let's break it down with the actual numbers from the earnings call. On the surface, Netflix delivered Q2 revenue 12.56 billion, up 13.4% YoY. Operating margin 33.4%, in line with the guidance. EPS at 80 cents. And the ad business is scaling forward roughly 3 billion this year. That's a projected doubling from the Netflix on guidance. The content slate is also working. So why did investors sell? Because the market doesn't value Netflix on today, it values Netflix on the future. And three questions got louder today: engagement, cash timing, and whether the growth story is decelerating or just pausing. Netflix stock fell after an earnings beat. Here is the uncomfortable question: is Netflix growing because more people are watching it more, or because Netflix got better at charging more? First half revenue grew 13%, viewing hours grew just 2%, and that 2% is actually slightly better than the last year's 1.5%. But the gap between revenue growth and engagement growth is widening. And then Netflix dropped this. From 2027, viewing data goes from twice a year to once a year only. Management says focus on revenue and profit is main, and not only the viewing hours disclosure. The counter argument: if engagement is the foundation of pricing power, less transparency is a red flag, because the metric that justifies the premium is becoming harder to track. Now, management has a real defense, and it's not just excuses. They said it directly on the earnings call. All hours are not created equal. Live events are 5% of the content spent, but only 1% of view hours. 8. 6 of the top 10 new members sign up days in the last 5 years came from the live events only. The Winter Olympics and the FIFA World Cup in the first half, and Netflix overcame them. Hours still grew 2%. And second season retention, management says it's actually improved year over year. So the argument isn't that the engagement is collapsing, it's that the type of engagement is changing. The question is, can a company growing revenue 13% justify a premium valuation if raw hours are growing much slower? The second issue: operating profit was 4.2 billion, but free cash flow was 1.5 billion, which is below the estimate of 2.6 billion. Netflix cited higher cash taxes related to Warner Bros. Termination fee. That's a valid one-time explanation. Here is what else matters. Netflix bought back 4.7 billion of stock this quarter. That's their largest buyback ever. And investors are watching whether cash generation keeps pace with the growth story. Netflix said something that should terrify the competitors and excite the investors. They are only 5% of the global TV views here. After 20 years, 330 million households and a billion people. They see 800 million addressable households and a $670 billion TAM. The bull case, they are just getting started. And the bear case, if you are only 5% after 20 years and revenue growth is decelerating from 16% to 11%, what does it take to get to 10% and 15% market? Live sports, cloud, gaming, the AI powered production, free trials, every new bet costs money, and that cash flow, it's getting thinner and thinner. The next 6 months will tell us Netflix is a cash cow company or if its growth engine still has room to run. The valuation: at around current price, Netflix trades at 19 times adjusted forward earnings. That does not look expensive for companies of this quality. The bull case is clear. Advertising grows, buybacks continue, margins expand. Netflix becomes more than a streaming company. But the market is asking how much of that future is already priced in current price. Here is what would prove the bears wrong. Revenue reaches the top end of that 51.4 billion full year guidance. Advertising becomes a meaningful growth engine. Viewing hours reaccelerate, and cash generation catches up with the reported profits. The bear case wins if cash spending keeps running ahead of expense recognition, growth slows further, and expectation remains too high. Netflix is not broken. It remains one of the strongest business in entertainment. But the market is no longer asking whether Netflix can win. It is asking whether Netflix can continue exceeding very high expectations. That was the message behind this sell-off. The great company, higher expectation, tougher stock. Thank you.